The iconic 4% rule that many have trusted for their retirement planning has now evolved into the 4.7% rule. And this change could have a significant impact on how you prepare for your golden years. But here's where it gets controversial. What started as a simple guideline might no longer fit today's complex financial landscape. Back in the early 1990s, financial advisor Bill Bengen introduced what became known as the 4% rule. This straightforward strategy instructed retirees to withdraw 4% of their total savings in the first year of retirement, and then adjust that amount annually for inflation, aiming to ensure their nest egg lasted for about 30 years. It became wildly popular because it offered a simple answer to a deeply complicated question: how to make sure your money doesn't run out. Yet, after decades of widespread use and debate, Bengen himself now advocates for a revision, a new 4.7% rule, which suggests that retirees might be able to safely draw a slightly higher percentage than once thought. The story of the 4% rule is as much about its strengths as its limitations. Its brilliance lies in making a complex challenge feel much more approachable, according to Rob Williams, Managing Director of Financial Planning at Charles Schwab. It's memorable and helps people break down a complicated human problem into something manageable, he explains. However, this rule was developed in a very different financial era, when the typical portfolio consisted of an even split between stocks and bonds, the precise mix Bengen used when crafting his original guideline. Today, financial advice often involves a much broader diversity of investments, spanning multiple types of stocks, bonds, real estate, and many others, and even cash equivalents. This evolution in asset allocation fundamentally shifts the risk and return calculations that underpin withdrawal rates. To understand how the 4% rule transformed into the 4.7% rule, we need to look back at its origins. In 1994, based on historical data analysis and published in the Journal of Financial Planning, Bengen concluded that withdrawing approximately 4.15% annually, rounded down to 4%, would help retirees avoid running out of money over 3 decades. This conclusion surprised many, including Bengen himself, who described the phenomenon as almost surreal given the rule's enduring presence 30 years later. Over time, Bengen has refined his approach, incorporating a wider array of assets, including large, mid, and small company stocks, international equities, bonds, and treasury bills. His current model assumes a portfolio consisting of 55% stocks, 40% bonds, and 5% cash, reflecting more nuanced diversification. Thanks to stronger stock market performance and advances in research methodology, he now suggests that a withdrawal rate of 4.7% could be sustainable, a notable uptick from the original 4% figure. Bengen practices what he preaches, revealing that when he retired in 2013, he initially withdrew 4.5% of his savings in the first year. But seeing the market perform well, he gradually increased his spending to nearly 4.9%, demonstrating how real-life experiences can modify theoretical rules. Despite these updates, the 4% rule remains a foundational concept in retirement planning, though it is far from universally accepted. Critics argue it is overly simplistic and doesn't reflect modern market realities or individual circumstances. Caleb Silver, editor-in-chief of Investopedia, emphasizes that while the 4% figure is a useful rule of thumb, truly effective retirement strategies require considering an individual's unique lifestyle and spending needs. Rob Williams concurs, highlighting that retirement plans should be dynamic, regularly revisited, and adjusted based on factors like inflation, investment returns, and changing personal situations. Douglas Ornstein of TIAA Wealth Management notes that retirees rarely have static spending patterns over multiple decades. They fluctuate depending on life's twists and turns. One of the reasons the 4% rule resonates so deeply is its connection to a widespread fear: running out of money. In fact, surveys suggest that many Americans dread financial exhaustion in retirement, even more than death itself. As Williams puts it, retirement spending is a difficult question psychologically, and simple frameworks like the 4% rule give people a starting point to confront that anxiety. Yet there's a catch. Many retirees misunderstand the rule and either adhere to it too rigidly or use it improperly. Bengen reports receiving numerous inquiries from people who take the 4% literally, as in always withdrawing exactly 4% of their savings annually, without adjusting for inflation or life changes. The rule actually advises a starting withdrawal of 4% in year one, say $20,000 from $500,000 saved. Then, increasing that amount each year in line with inflation. 3% inflation means $26,600 in year two. It's a subtle but crucial distinction that can mean the difference between a sustainable income and prematurely depleting assets. Another limitation is that the 4% rule naturally favors those with larger savings. The median retirement savings for Americans aged 55 to 65 is around $185,000. Applying the 4% rule here translates to only about $7,400 in annual withdrawals, which is hardly sufficient to maintain most lifestyles. Amy Arnett, a portfolio strategist at Morningstar, points out that many families have little or no retirement savings at all, underscoring that the 4% or 4.7% rules aren't one-size-fits-all solutions. Ultimately, Bengen designed his rule conservatively with the aim of protecting retirees across every economic environment over the past century. He admits many retirees could likely spend more than 4%, but it remained a cautious benchmark to reduce risk. So, what should you take away from this? Is the 4% or 4.7% rule a reliable guide in today's retirement world? Or has it become an outdated relic that needs a fresh perspective? How should you balance simplicity and personalized flexibility when planning your own financial future? These questions invite plenty of debate, and now it's your turn. Do you trust the updated 4.7% rule, or do you think retirement planning should go beyond any fixed percentage? Share your thoughts, agree, disagree, or offer your own approach in the comments below. After all, retirement is a deeply personal journey, and no single rule can perfectly fit everyone.